weekend all. Ira Epstein with your weekend edition of your metal markets. And this is for Friday, and we are now at the 17th of May, 2019, just before 4 p.m. Central Daylight Time, about 3:45. So, lot to talk about, but remember what we do in the weekend edition. We're going to look first at a monthly chart, and then everything else is going to be on a weekly basis. The idea is to give us a bit of the longer term picture, get rid of the noise of day-to-day trading. So that helps some traders. The events this week are huge. It has been announced that within 48 hours, the metal tariffs between between Canada, Mexico, and the United States should be falling off. At that point, I believe that the president of Mexico will sign into law a labor law that Ms. Pelosi, the Speaker of our House, wanted him to do. This should clear the way for movement back into Congress to pass the old NAFTA trading, but the new trade deal that we're putting together, USMCA, I believe it's called. Then, as you know, yesterday, President Trump slapped a lot of restrictions on what we will do with Huawei, the huge telecom company. It's bigger than ZTE, and that was the deal in December. So now we move forward, and it's full-out warfare now. It's no longer nice guys to each other. Now how do you hurt each other in a big way? China basically uninvited us back to the table, claiming that we're the bad guys. And the reason we're the bad guys is because they were negotiating. They want to backtrack on what they did, and we called them on it. No different than them not wanting to put in laws, remember that, to protect not only U.S., but other companies that do business. Nobody has the right to steal your intellectual property. It's that simple. Nobody. They believe they do. Enough of that. So the stock market's reacting to that late-day development today in the negative about China. It reacted positively when it heard that we were going to remove the 25% tariff on steel, 10% on aluminum to both Canada and to Mexico. But that's overriding the market. In the metal markets, what this is doing, well, it takes out some of the inflationary steam, doesn't it? If you think about it, I think we get like 19% of our steel from Canada, about 11%, and I'm talking steel and aluminum, from Mexico. That's about 30% of our needs, and you're going to remove a lot of these cost structures to it. That takes out the wind here. Copper, of course, what do you do with that? Because this trade war is getting worse, not better, until the two presidents are able to tone it down, maybe when they meet at the G20. This weekend, you're dealing also with OPEC. So I know I'm talking a lot before I get to the charts, but OPEC has its meeting in Saudi Arabia. It's the pre-meeting to June, and it really sort of sets the tone. Are they going to up production or not? And the market thinks they might, so you set back. So let's get to our first chart, and this is our monthly gold chart. You have been stuck in sideways action since right here. It began as you popped out in 2016 to this top, then you started narrowing in, and you've been going sideways ever since. This is the 18-month moving average of closes. If this market gets under 1266 and closes under that, you could easily put back in the play, getting back to the lower Bollinger Band. On the other hand, you could get false moves against it, but that would turn the trend. Right now, you've got lower highs, you've had lower lows, but remember, each bar is a month. You've been staying over this 18-month moving average. Get under that and close under that low, the chart starts looking more bearish, which means if the bulls are going to defend their position, another way to look at it, they should do it right here and right now. They failed 4 months ago when we had this rally to take out this high. That was the failure in the market. When we take a look at a weekly chart of only closing prices, and the reason I like to do that, you can see easily, are you making higher highs, lower lows? What are you doing? Are you disagreeing with me that you've got the lower highs, and then all of a sudden we had a pop last week where you changed the pattern, and this week you took that out again. So now you've got a market that's made a lower low and a higher high. It's gone into a stall on a closing basis. But there's something more important. You've kept the bias of the market down if you consider that the 18-week moving average, if you're over it, you have an upside bias, under it a downside, and that triggers other of your technical tools. When we take a look at the weekly bar chart, I'd like to put on this chart right now the swing line. And on the swing line, you've had a pattern in place. Lower highs, lower lows. This is an outside week down. If you take out this week's high, either next week or the week after, I will call that a bear trap that you've had here. But if the market first goes down and makes a lower low, then I don't care what it does. That'll be the key to me, to the market. I'm also looking here at that 1266 period, and that's the number that I'm studying. Where are you caught in this market? This green line is the 100-week moving average of closes. And when the market was up like it was here, the first number it tried to stall at was the 18-week average. I think you see that crystal clear. The next number, if you're just using moving averages for support, would be the 100-week. If it kept falling, maybe you're going to the 200. I have day. These are weekly, believe me. I wrote that wrong. Whereas the resistance, well, the 18-week, now what you're doing is slipping back, and you fell back into this area right here. But because you closed lower until this high is taken out, if you bust through here, you're either going and looking at the 200-week moving average, not the day, that's just my error there, or you're looking at the closer of the Bollinger Band. I'll take the closer of. So this number happens to fit in right at this 266 level. We're at an important juncture if the market slips through this 100-day down to there, 100-week average down to there, and the resistance is 1297. When you come to the momentum has gone flat. It's really not pushing down. It just sort of went sideways, and we've been doing that as we had a rally that didn't follow through. When we come to the GLD ETF, let's take this off. Let's look coming into this week what we did. We found support between the challenge, first the 100 at the 18-week, next the 100-week. We had hit it once, we fell back, got through it. If you follow through, I'd look for the lower Bollinger Band. You did it, and you came right back on that week to the 100-week average. Now, where's the resistance? Well, I'm going to argue if it keeps going, a number that could be in play is the 18-week in red. The market hangs in another week right at this number, hangs in, this is the week of May 10th, gets up this week, gets to that number with an outside week down. If you fall again in this market, I think you're putting into play again that lower Bollinger Band. If you rally, the resistance is up at the 18-week. You have to take out this week's high to say, maybe I've got a trap going on for the bears. I think the bears control this market. In GDX, the ETF, the popular gold miners, let's take another look. The market at first rallying, falls down. Finishes this week at 2134. It's right into just under this 2183, the 18-week and the 100-week. If it keeps going down, you're putting into play the possibility of the lower Bollinger Band with resistance back at the combination of those numbers. You get down there May 3rd. You give a little bounce to the market, doesn't really go anywhere, closes lower there. You come up this week, and this is where you're at right now. A bit higher, but you still have lower highs, lower lows. You've hit a downside target. I still see that 2175 as a serious resistance point. What tells you that industrial metals aren't in good shape is often, it is not the word always, often, if they're going to be in good shape, gold loses to them. Bull markets require industrial metals to also go with the gold. That's what I've learned over my 50 years. Is it every year like that? It is not. I'm talking the generalities. What's happening is the higher we're moving up on this chart, you're needing more silver to buy an ounce of gold. That is not how industrial metals go. And yes, I think silver is an industrial, not a precious metal. And when I look at this chart, lower highs, lower lows, pushing out the Bollinger Band, the new lows. It could keep running this. There's nothing on this chart that's friendly. Remember, you don't get overbought or oversold on weekly charts the way I teach charting. You're just pushing this right on down. In the copper market, falling down, pretty good break at this point in time, down 440 points for the week. Looking at how the chart action is, can you get back into this 269.60 level is going to be one of the questions. Obviously, seeing China and the U.S. go really now toe-to-toe like a boxing match, not good for world demand for copper, at least in my opinion. In the platinum market, lower highs, lower lows, back under the 18-week average. If anything, this threw out new ideas to be bearish again in the market with the lower high and lower low that close under the 18-week and momentum turning down. Doesn't mean I'm right, but until you get back over this 887.50, the pattern is bearish. Lower highs, lower lows, momentum down, bias down. In the palladium market, we've had a pattern of this higher high and lower low. The hardest thing in this market was it ran dramatically from August all the way up to peaking out in April. It was a very dramatic price rise, and the market had made a top, and now it's the wishy-washy action you get from that. In the dollar index, is the dollar moving out for new highs? So far, each little break we've had is still being supported at the 18-week average. The bias is up, therefore. Is the market trending? Well, here's one of the things. You go back to this week's low, 96.87, the week of May 3rd. You can see that right over my shoulder here. So we have a low of 97.86.5. The market gets a bounce the week after, comes down to 96.81, just takes that out and back up. Puts into play the upper Bollinger Band as resistance. I cannot any longer say you've got the higher high, higher low pattern. So you're sort of caught in this mishmash, if you will, right here, and that's been what this trade is about. The problem has been for traders, the trade of the year was the dollar was going to be down, if you'll recall. Other currencies up, emerging markets going to be strong. Hasn't been the case. We're the currency of choice right now. I talk about this and a lot more in my morning subscriber video. So let me explain the idea here. I wake up early. By 6:15 a.m., I am recording. Now, I'm not in that video. This is exactly what the screens look like. They'll have window envelopes, these moving averages, other tools. I will go in and do pivot point analysis with you from time to time. I'm going to review over 40 charts. It's typically 40 futures and about 5 ETFs. The idea is you have a cup of coffee and you've come maybe with an idea. You don't have to, but maybe you did. I'm going to cover the markets in the same sequence every time, but the beauty is on this side of the chart, you can click the word grains, meats, wherever you want to go. The video will take you right to that spot. That's a new feature we added. And what's different about this video than all the others you see on YouTube is I can get very specific. I can say buy here, sell there. Here's your stop order. Here's your buy order. In these videos right now that you're watching me on, I have to be much more generic. That's just the way it works. You're going to see me cover all this. Why do I do this at 6:15, begin the recording? Most U.S. reports, economic reports, come out at 7:30 until maybe 10 in the morning. Different time frames, but that's when they come out, government reports and private reports. Well, I can go over those before they come out, but I also already know what's happened in Asia. I know what's happened in Europe at that point. Everybody's waiting to wake up and the trading to begin, and now we've got the markets open and we can talk to each other. So you have a trade idea. Maybe you're looking for somebody and you're going, I'd like to know, does somebody else think the way I am? Maybe you're looking to say, I like this, but maybe I don't know. What does somebody else that I respect think of the market? That's what this tape is about. I'm hoping you respect what I do. I charge for it. It's not free. 26.5 cents a day to give it a try. $7.95 for your first 30 days, no contract, no commitments of any type. What you can do is you can decide, do you want to take that? If so, afterwards, it goes at $15 every 30 days. Notice it's not by the month. It's by 30-day periods. If you decide to take out a 1-year subscription, I break the price down. Instead of $15 for the next month, it's $13 and you pay it all up front. Pretty simple. What do you have to lose but $7.95? If you'd like to find out more, go to www.iraepstein.com under the word education or research. Ira's morning subscriber video, away you go.